Good afternoon, everybody. Welcome to the Stock Analysis Crash Course by Team Rise Up and the Black Day Trader. We'll quickly discuss our objectives and our reason for hosting this training this afternoon. What we hope to do here is to outline and demonstrate the processes involved in the analysis of long-term and mid-term investments. So what we mean by that is we're going to teach you guys how to look at the Fortune 500 list or stocks in these emerging markets and analyze their financial statements in such a way that will help you to determine whether or not you want to hold these long or midterm. So we're not going to be talking about the evaluation of meme stocks or anything like that today. We are talking about long-term and mid-term generational wealth building stock portfolios and how it is we go about analyzing companies for those portfolios. So we're going to talk about the some basics about the stock market, just kind of how things work. And then Ronnie will talk about the financial statements and how to find the information that we need, the key or the fundamental metrics that we need on those statements. So here we're going to talk about some myths and misinformation that may have been keeping you guys from investing in the stock market.
Yeah, so we've already heard, I'm sure plenty of you have heard all kinds of different things said, misinformation about the markets. And, I believe that's by design to get you, to keep you away from trying to learn and trying to better yourselves through investing. People say things like it equates to gambling, you're going to lose your money. And typically people who say this are people who have never invested a day in their lives. So you'll hear I've heard people say it's only for rich people or it's only for white people, things like that. These are all myths and things to kind of keep you away from doing what everybody who is doing well financially, they're all going to the money well, which is the stock market. So people will tell you to stay away from certain companies or, just do the basics and buy brands that you're familiar with and things like that. And that could be a good thing, but it also doesn't translate to being to your brokerage account increasing. Maybe it's not a good investment. So what we hope to do today is to show you the basics of what you need, where you can walk away from here and you can start your brokerage as early as Monday morning, based off the information that we're about to show you in this training. So why should you learn to invest? Most households, half the people in this country invest in the stock market. Most of the wealthy to do people, they invest in the stock markets as well. But the main thing that this pandemic, if it hasn't taught us anything else, it's taught us that in a time of a crisis or something like that, we Black people tend to not have disposable income. They don't have assets that they could liquidate in a short period of time that could help save them in the midst of a pandemic. We see that the government stepped in, and had they not, it would have been pandemonium in America because a lot of people don't have disposable money or assets that could be liquidated in the stock market. Assets that could be liquidated in a short period of time. And so now we're going to talk about some stock market basic concepts.
So we're going to cover. Now we're going to cover just some basics about how the stock market works and how it is that we go about accessing the stock market. So we'll talk about corporations, and under that title, we'll get into ticker symbols, stock exchanges, brokerages, and so forth. But I'm going to try to explain it to you guys, basically the way it works, kind of in layman terms. so that you can relate to it easily. So the first aspect, or maybe the most important aspect of investing, is the corporations themselves. When you buy shares, you're buying shares of corporations. And these are just legal entities that are formed through the state that they operate in. And when these companies become incorporated, it entitles them to also become publicly traded or to list their shares on stock exchanges. And in the United States, investment banks oversee this process. It's called the IPO process. So basically, the corporation goes and solicits the help of the investment bank with the process of taking their shares to market or being able to offer their shares for sale to people like you and I. So during that IPO process, institutional investors and accredited investors are entitled to buy shares before you and I are. But once the IPO is finished, we're able to purchase those shares through stock brokerages. The purpose for corporations going public or going through that IPO process is to raise capital. And when we buy shares of these companies, what we're doing is we're kind of loaning them capital. So I want you to think about it in those terms. When you decide to buy a share in a company, what you're essentially doing is giving them your money and investing in whatever business processes they're engaging in. So later on, we'll talk about how we kind of look at their credit worthiness in some of the same ways that they look at our credit worthiness when they're considering whether or not to give us loans. But along with the right to get capital from the market and offer their shares for sale to us, they have certain responsibilities. Some of those responsibilities are that they must report on their financial well-being to the Securities and Exchange Commission. And as investors or potential investors, we are entitled to view those financial statements in the process of doing our due diligence. So the investment banks are another important segment of this process. Those are the people that, say, an Apple or Nike would go to before they're a public company when they're interested in having an IPO. So in exchange for the investment banks helping these companies to IPO, they usually get a significant amount of shares and the option to buy shares at discounted prices. So the corporations go to the investment banks then, once the IPO is completed, list the shares on a stock exchange. The stock exchanges in the United States are the New York Stock Exchange and the NASDAQ. And if we're talking about options, it's the Chicago Board Options Exchange. I'm not going to get too much into this because I feel like everybody here knows what the stock exchanges are and what their purpose are, but they're basically an intermediary between us and the companies who we want to buy shares from. When companies list, when they go through their process of IPO and listing their shares on the stock exchange, they are given a ticker symbol. And what the ticker symbol is, I won't go into how they were derived or why they were derived, but what it is basically the company's address on the stock exchange. And usually they are 3 to 4 symbol in this country, usually letters, 3 to 4 letters. So for example, TJ Maxx's ticker symbol is TJX, Apple's ticker symbol is AAPL, Walmart's ticker symbol is WNMT. But if you ever do not know the ticker symbol for a company that you're interested in researching, you can just go and type Walmart ticker symbol in a Google search and it'll give it to you. But eventually you'll get to the point where you know the ticker symbols. So we cannot go directly to the investment bank or to the stock exchange to buy shares. We have to go through stockbrokers via brokerage accounts. So we have encouraged you guys to open Webull accounts for the purpose of this training. I think that is one of the better not large brokerages, but some of the other options that you have when you guys get into the large brokerages are like Fidelity, Charles Schwab, E-Trade, and the likes. So what they do is They kind of act as another intermediary where we have access. So we go to the stock brokerage through our brokerage accounts, and they facilitate the buy and sell of stocks from the stock exchanges. We cannot go directly to the stock exchanges ourselves. Another very important factor, and something that I always consider, and I'll talk about it now so I make sure that I don't forget to talk about it later. Another factor that I always consider in my investing is institutional ownership. And what institutional investors are large entities, companies, our insurance companies, colleges, credit unions, banks, who, like us or like we're seeking to do by taking this training, go to the stock market and buy shares for the purpose of growing their capital. So we'll talk about some of them because you may not be aware of them, but hedge funds are one example. And what those are, in just really plain terms, is groups of wealthy investors who pool their funds to invest in stocks, oftentimes highly risky or speculative stocks, in hopes of realizing large returns. Endowment funds are associated with colleges and universities. When we graduate, or when people graduate from colleges and universities and give back in the forms of donations, these colleges and universities create endowment funds with those donations. And a part of what they do with those is invest them in the stock market, buy shares, just like we're encouraging you guys to do, so that they can finance some of the things that they need to do: buy real estate, hire the best talent, create new programs at their institutions with their gains from the stock market. Sovereign wealth funds are usually associated with countries. These are where countries pool funds, state-owned funds, to invest in stocks and bonds and so forth, with the same purpose: growing their funds or growing their capital via the stock market. Real estate investment trust is something that you may be looking at when you go to create these portfolios. But what they are the same kind of concept, but they pool their funds to invest in real estate. Everybody is probably familiar with pension funds. Pension funds do the same thing. When you contribute to a pension, or you are entitled to a pension, those funds that you are receiving when you retire are coming from gains that these companies have derived from the stock market. So those are institutional investors. And what I like to consider when I'm making investment decisions is how many of these large, smart, successful, profitable, different kinds of funds and institutions are invested in the stock that I'm looking to invest into. I feel like if they're invested, then that can confirm what I see looking at the metrics, or whatever has made me interested in the company. If these large institutional investors are not involved, then that will make me think twice about investing my funds. The indices. So these are old, hundreds of years old, but what they are is kind of pools of different stocks that the Dow Jones Industrial Average, the NASDAQ Composite, and the S&P track. And what they're supposed to do is give us an idea of the overall health of the stock market, I guess. So there are 500 companies in the Standard & Poor's, 30 in the Dow Jones Industrial Average, but they have a process or a formula of using those 500 or 30 companies, for example, as a metric of the overall health of the stock market. So I think that these, for me, they apply more to the trading side, but it is worthwhile because a lot of the companies that you're going to be looking at the Fortune 500 list to find investment options will also be in the Standard & Poor's and some of these other indices. So to break the market down further, I'm not sure how many companies there are listed on the American stock exchanges, but they're all broken down into sectors and industries. So there are 11 sectors, 11 stock market sectors. And this becomes relevant when you talk about diversification with this first portfolio or first couple portfolios that you'll be creating. So For example, you may want to make sure that your funds are invested in some of each of these broad sectors in the industry, in energy industry. Healthcare is one that's popular right now. Some of the things that will be considered or included in the consumer staples sectors are like your Walmarts, some of the toilet paper and toothpaste brands. Hopefully we all know what staples means, and we can compare that to discretionary. Those are items that we don't necessarily have to buy, but when we have discretionary income, when the economy is doing well, those things will flourish. So by diversifying into these 11 sectors, you kind of cover yourself in situations like the one that we've been in for the last year, because consumer staples have been consistently doing well, whereas consumer discretionary is not doing as well because, like Ronnie talked about, a bunch of us just don't have discretionary income right now. So the sectors are broken down into 24 industry groups and 68 industries and 157 sub-industries. And I don't really get into, and I don't think that it's necessary for you to understand all of these different industry groups and sub-industries. But what I do want you to get is a general understanding of how this relates to diversification. So let's talk a little bit about so, for example, in the financial sector, you would find banks, you would find some software providers like Square, MoneyGram would be in the financial sector. But in the sector, there will be a bunch of companies that have anything to do with finance, but they would not all be banks. Just like in consumer staples, you would find the people who make the toilet paper and the people who sell the toilet paper. So hopefully that gives you an understanding of how the breakdown of sectors and industries work. And hopefully you understand how to consider or diversify yourself across these different industries. If not, you guys can follow up with us at some point after the training to get a better understanding of that. But I have listed them here for you guys. So hopefully that gives you a broad understanding of what it is that we're doing and how it is that us as individual investors get to the money. So now we'll go right into how to analyze stocks and how to use the metrics and some tools that you guys can find online. So at this point, hopefully you have your laptops open. It may be good if you have a calculator and a pen and pencil to take notes, but Ronnie is going to go into the process of analyzing the financial statements for selecting long-term investments.
All right, cool. As I get my screen, pull my screen up here. What is sharing? You see why Yahoo Finance? Okay, cool. So what I'm going to do is I'm going to read you the information, give you the information about what to look for, and I'm going to go over it as I do that, and then I'm going to show you how to plug in the information. So how do you judge whether a company is good or is worthy of, as Leslie talked about earlier, is like you have to look at this, you're investing your money, so you should want to invest your money into a well-managed company that you feel like is going to give you a return on your money. So with that, you have to be picky and know how to pick quality companies. So that's what we're going to go through right here. And the only way you could tell that is not by how you feel. Stock markets does not care how we feels. Um, it's not based upon what you like. It's not based upon buying things that you see all the time, because I can guarantee you it's a lot of companies that you see every day that you would think would be profitable, but they're not, especially. So what I'm saying is, how do you tell whether a company is well managed? Uh, Numbers don't lie. You look at their books. And that's what we're going to do right now. We're going to look at the financial statements. So there are three financial statements: the cash flow statement, the income statement, and the balance sheet. Now, the cash flow statement is a financial statement that shows how changes in balance sheet accounts and in income affect cash and cash equivalents, and breaks the analysis down to operating, investing, and financing activities. Um, this is where you determine whether the company is one of the ways where you determine whether a company is profitable by tracing how much cash they have. The income statement is also known as the profit and loss statement, or the statement of revenue and expense. The income statement primarily focuses on the company's revenue and its expenses during a particular period. And then we have the balance sheet. The balance sheet is a statement of assets, liabilities, and capital of a business or other organization at a particular point in time, detailing the balance of income and expenditure over the preceding period. So when we look at the cash flow statement, basically the main thing that we're looking for is how much cash on hand do they have? How much cash on hand do they have? So in order to look at these financial statements, you will come right here to financials on, I'm using Yahoo Finance. We're going to look at Walmart, and we're going to look at Amazon as well. I'm going to give you two examples. So the financials we see here, we see the income statement on this tab, and that breaks down all of the information on the income statement. Now we're going to show you what's the pertinent information that you need in order to do your research and evaluate a stock. Then there's the balance sheet. Here's all the information. This is where you find out whether a company is worthy of your money being invested in, because they're going to take your money and use it, and you're saying, okay, take my money and use it, but grow it. So then this is the cash flow statement. Now, we will be looking at the cash on hand let's look at the cash flow statement first, which we're on. We will be coming down here, and this is what we want to see. This is the main metric from the cash flow statement. We want to see free cash flow. You see Walmart and TT. So usually you could break this down and look at things quarterly, which is every 3 months, or you could break it down annually. I look at it annually because it would be way too many numbers to look at if I wanted to look back the last 10 years, which is what I suggest that you all do when you're evaluating a company. It's much easier to do it on an annual chart. So, and so these are the prior years, every year, but this TTM stands for trailing 12 months. That means from May 29th today to May 29th last year. This is what Walmart has been doing, for instance. So TTM, that's what that stands for. So that's the main metric we're looking for. We want to make sure that they have cash, and we want to make sure that they have a lot of it, and we want to make sure that they have that is continually to grow every year. We like to see that, right? We like to see that it continues to grow year to year. So So that's the cash flow statement. Next, we're going to look at the income statement. And the income statement gives us, by it showing the company's revenues and expenses during a particular period, it indicates how the revenues are transformed into the net income or net profit. For the purposes of our analysis, we're going to look at the following metrics on the income statement. We'll be checking out the operating income, interest expense. We'll be talking about the net income and the revenue. So up here is where you will find the revenue. You see the revenue, and again, just like cash flow, this is a good thing. We want to see that every year we want to see this revenue getting bigger and bigger. We want to see a lot of money being made. Why? Because that means that if they're making money, chances are that they're being profitable and that their stock price is going up. That's what we want to see. Then we'll get into dividends and things like that, which is something that they give to share. A lot of companies do. Really good companies, especially on the Fortune 500, a lot of them do give dividends. So that's important. Operating income, we can find that on the income statement as well. It's right here in this column. And the operating income is an accounting figure that measures the amount of profit realized from a business operations after deducting the operating expenses such as wages, depreciation, cost of goods sold, things like that. So this is how much money they have after they've taken care of their business, the operating income. Okay. So we'll also be looking at the interest income. Now we gotta go down a little bit. All right, interest expense. Interest expense relates to the cost of borrowing money. It is the price that a lender charges a borrower for the use of the lender's money. On the income statement, interest expense can represent the cost of borrowing money from banks, bond investors, or other sources. So we use the operating income and the interest expense, which is right here in this column. We use that to determine the debt ratio and see how much debt a company has. And the debt ratio is basically calculated by dividing the interest expense by the operating income, then multiplying that figure by 100. And we're going to do that here in a second. The debt ratio represents the percentage of each dollar earned that is used to service debt. For example, a ratio of 12.12 means that $12.20 of every $100 is spent towards servicing the debt. The ideal upper limit for this ratio is 12 to 14%, but keep in mind that the lower this number is, the better. Debt ratio is something that's very important for me when I'm evaluating a stock. It's one of my top metrics that I look for. And this, I can't stress enough that you want to have as less debt as a company that has as less debt as possible. Although debt isn't a bad thing, it can't be a good thing if it's a lot. So if a company, using the example that was given on the slide, if a company makes $100, if they're spending $40 servicing the debt, then how much money, how profitable of a company could they possibly be? So you want to get something that ideally you want to get something below 10%, but 12 to 14, anything above 12 to 14, I would probably side eye and have to look at some other factors, some other metrics to justify me again finding this company worthy of my money. If they're spending a lot of money of their service and debt, that could come back to bite you. For example, when the airlines crashed, when the airlines went down last year, the price uh, due to the pandemic, that wasn't their fault. It's just a thing that happened, and the companies that uh, suffered the most were the companies that had a lot of debt. Companies like ALK, Alaskan Airlines, and Southwest, those companies were able to take that lick and keep going because they didn't have a lot of debt. They could take on some debt due to the pandemic, whereas a company like American Airlines had a lot of debt going into the pandemic, and then they needed a lot. So now they're even more debt. Um, on the coming out of the pandemic, they needed a lot of help during the pandemic. So that's what you want to be mindful of, and that's why it's important to watch the debt and make sure that they don't have a lot, because if they come into any kind of trouble, especially an oil company or in different certain sectors, if they have issues or whatever, um, and they have a lot of debt, they probably won't be able to be profitable if they run into issues. Uh, and then we'll be looking at net income as well. Net income, also called net earnings, is a sales minus cost of goods sold, general expenses, taxes, and interest. You can find net income. Uh, Usually, I look for net income available to stockholders. That doesn't mean that all this money is available to you all. Uh, that does mean that they're making money, and you want to see that again. You want to see this grow every year. But the truth of the matter uh, is very, very rare. It's like finding a needle in a haystack to find a company that consistently every year has more numbers. But what you want to see is gradual growth. Um, and sometimes it's not going to, like we see right here, this year was lower than the previous year, but that's okay. It caught back on track the next year, and then the next year it went even higher. So that's another one of those things you just got to be mindful of and watching closely. So, and then there's profitability of a company. Um, this is a way of you telling whether, again, a company has a lot of debt. And if you go over here to the statistics, um, and you look down here, see that where it says profitability? All right. So you want to look at the profit margin, which gauges the degree to which a company or business activity makes money, essentially by dividing income by revenue. It comes in a percentage, as we can see right here. Profit margin indicates how many cents of profit has been generated for each dollar of sale. The three types of profit margin are calculated by dividing the profit figure by revenue and multiplying by 100. Um, and then the operating margin right here. The operating margin measures how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages and raw materials, but before paying interest or tax. It is calculated by dividing a company's operating income by its net sales. That's how you get this percentage. Now, what you want to see here, again, let me show you how to get it, how to find it on Yahoo Finance. You come up here and you go to statistics, and you come down to profitability, and you look at these percentages. Now, what you want to see from these two percentages, take notes of this, that they should be tight. They should be no more than 10% apart. If they are, so like, in other words, this is 5%, and let's say if this was 15, let's say this was 20%, well, that's more than 15%. Without even doing the debt ratio, looking at the debt ratio, I can look at this right here and tell you that there's a high chance that this company has a lot of debt. However, if it's lower than 10%, like it is now, it's only a 3% difference. That tells me, without even looking at the debt ratio, that I'm kind of in a good range. It's nice and tight right here. And just another thing, the profit margin is kind of low, and the operating margins are kind of low. That will look different per sector, right? So the sector that Walmart is in, that may be average for that sector. So don't go get blown away and say, "Ooh, that's just, that's 2% and 5%. Those are low numbers." Don't get caught up in that, because look at then the more research you would do, you would look at what is the average of that particular sector. So this may be their range, whereas a tech company their percentages may be 40% and 45%, and but that's kind of the range of that particular sector, if you all are following. So those are things to consider as far as how to this is kind of like a cheat code as to seeing the debt. You could come here and see that if it's more than 10%, then it's probably got a lot of debt. You want it tight. You want those numbers as close as possible, and not more than 10%. Okay. Uh, so now we're going to go over a company. We have a sheet that we use, and it's very easy to use, and it actually does the once you chart all the data in, and you see we got all the companies here where you could go all the way down and do all your research, and you'll have it right here on one sheet. So let's go. Let's get back to it. We're going to go to the financials, because the first thing they ask for, let's get to it, is cash flow, right? So we're going to do Walmart, and we're going to look up their cash flow. How we're going to do it? Again, we're going to financials. We go to their financials, and we go to cash flow tab. And what we're looking for is free cash flow. Some platforms say cash on hand. They both mean the same thing. So I'm just going to do this, copy it, and I'm going to take it over here to my sheet. I'm going to plug in the number. We did not talk about dividends. However, I'm going to show you where to find them on the chart. You go to the summary. That's basically the first page that'll come up when you're looking at a stock. And here we go. Forward yield. Forward yield. This is your dividend. Okay. Come right here to the summary page, which would be the first thing that they show you when you look at when you put in a company. You come right over here. So 220 is the dividend for this company, for Walmart. So you come over here, plug it in. All right. So now, revenue. Where do we find the revenue? Go back to finance. And we're at the income statement. And right there on the income statement, after hitting financials, you will find revenue. So again, I want the 2020 January 2021 information we're going to use. Copy that, plug it in. Is the revenue rising? Which is basically me saying, does the revenue increase? Me talking about earlier, the revenue increasing every year? Yes. Walmart's revenue has been rising. So we would just simply put yes. Operating income. Now, remember I told you that we use the operating income and the interest expense to figure out the debt. So again, you will find that on the income statement in the financials, okay? You scroll down, operating income. Plug in the numbers. Go to the next one, which is interest expense. We find the interest expense right here in the same place. On the financial page, on the income statement. We scroll down to the bottom, interest expense, 2021. There we go. Now, remember I talked about the debt ratio and how we use the operating. The debt ratio is the operating expense divided by the operating income. And that will give you a percentage. Now, when we plug this in, this is going to turn it, this box here is going to turn it to a percentage for you. Okay. And that is your, this 10 is your 10%. It's saying that this is 10% of debt. So their debt ratio is 10%. For every $100, Walmart spends $10.27 out of every $100 to service their debt. Okay. So then we will go to the net income. And this is the fourth metric that we look for on. Find that again by going to financials, going to the income statement, and then you're looking for net income. Go to it, click on it, copy. So basically this sheet just saves you a lot of time and is structured in a way where you can have all this data right here. It makes it easy to plug it in. And EPS is something else that's found in the summary. Here it is, EPS. That EPS stands for earnings per share. And you would take that and copy that. This metric is more about trading as opposed to investing. I think it has more makes more, it holds more weight in trading than it does in investing. But nevertheless, here's the sheet. This is how you plug in all your numbers. And you should do your research back as far as, I would suggest, 10 years, as far back as you can, even if you're looking real thoroughly at a company, because you want to make sure that this company is going to last, that it could take a hit and keep going. And but the most important thing is that it can return value to you as a shareholder. All right. Let me say this. Let me reiterate this. So just so you all can get it, how to get the debt is basically taking the interest expense divided by the operating income, and then you multiply that by 100. Get your debt, to let you know what percentage of debt it is. Okay, so write that down. It's on the slide as well.
One thing that I want you guys to note on the worksheet that Ronnie just showed you is it simplifies everything for you, of course. There will be no questions looking at that worksheet, what information it is that you need to be hunting down. What I like most about it is that it calculates the debt ratio for you. So once you plug in the interest expense and the operating income, it's going to populate those numbers that Ronnie mentioned earlier should be below between 12 and 14%. But once you have all of those metrics plugged in, if you are savvy with Excel, then you're able to use the sort features to kind of do a process of elimination and find the best companies. But let me share my screen. So we'll get back to one of what I think is the more important or the most important metrics for wealth building. And Ronnie talked about it. I think it may be the first column on that worksheet, and that's dividends. And Ronnie's philosophy, and I agree, is that if a company's dividends or if a company's metrics are good, they have cash, their revenue has been increasing, they're not spending a lot of their revenue to service their debt, more than likely they're going to pay a dividend, but that's not always the case. So when I completed that worksheet, the first thing that I did was sort by which companies offered the highest dividends. And for the purpose of my first generational wealth building portfolio, I just simply eliminated anybody who did not or any company that did not pay a dividend, because I was so focused on building dividend income for my descendants. We were sold on the idea that at some point our descendants will be able to live off dividends checks. And that was evidence for me when I was doing a consultation with a mortgage loan officer, who said that she had become interested in investing solely because in her work, she was constantly seeing people from other races being qualified for mortgages solely based on dividend income. So that became or has always been important to me. But when you're going through that worksheet, that's a way of kind of cutting down the amount of work that you have to do. You want to find out who pays dividends, and for the purpose of this first portfolio, focus on those companies. And if they have been kind of the reverse of what Ronnie said, if they have been consistently paying and growing their dividend over 50 or 60 years, then the chances are that the rest of the metrics will look good. But what I want to talk about now is just how you use what you've learned today to meet the goal of generational wealth building. So obviously, one of the most important factors with that is going to be do these companies consistently pay and increase their dividend? And if you don't know, a dividend is just a reward that I call it a reward, that companies pay to their shareholders on a per share basis. So if there's $1 dividend for every share that you hold, the company's going to reward you annually with $1. But there are some that are really high, $7, $14 and some change, I think, for BlackRock. Um, so we want to focus on companies, at least for the purpose of our first generational wealth building portfolio, that pay a dividend. Now, how you're going to go about, or at least in my experience, how you go about realizing some fantastic and even unbelievable gains with these companies is you're going to use your M1 portfolios that you guys set up. And once you've completed your research on that Fortune 500 list and found companies that consistently pay dividends, that have a lot of cash on hand and are well prepared. And when you think about it, it's just like talking about our personal finances. Do they have a lot of cash on hand to be able to handle any emergency? And in the corporate sense, COVID would be considered an emergency. In the personal finance sense, like your engine blowing, do I have money? If my engine blows, am I able to cover that with the cash that I have saved? Same concept with these companies. So do they have a lot of cash on hand? We are familiar probably with debt to income ratio. How much of their money is going to cover their debt? Once you found the best of the best, or what you consider the best of the best of those 500 companies, using the metrics that we discussed here today, what I encourage you to do is to dollar cost average into those particular companies. So if you decide that you want to invest in Amazon, even though they don't pay a dividend, I would not suggest that you go out and take your $3,600 and buy one share of Amazon. What I propose is that you create a pie of 20 or a portfolio of 20 to 25 companies in M1 and commit yourself over the next 12 months to depositing whatever it is that you can afford into that account based on your pay cycle. So it may be that you're doing it every week because you get paid every week or every 2 weeks or even every month. But what that does is, instead of buying any of the shares that you select at an all-time high or at the highest price that it has been at, it allows you to scale into those shares at all the prices that it may trade at over the course of a month if you're doing it weekly, or over the course of a year if you're doing it annually. And what my experience has been, what that also does is you'll really be amazed at the gains that you'll realize by just consistently. And I think I started with $50 a week or $100 a week. So you'll be amazed in a year or 2 years time what you can accumulate in terms of assets and gains, just setting this $50 or $100 or $1,000, if that's, what your financial situation will allow you to do, into these companies regularly over time. I told you how important dividends are. And so we'll just recap really quickly. And now's the time that if you guys have any questions about anything that we've talked about today, that you start to type those into the chat so we can make sure that they get addressed before we finish up today. But the way I was taught was that my first, because I had not been really investing into stocks prior to being taught, first stock portfolio is the foundation of your investing journey, and also the foundation of building generational wealth, particularly because we're going to be dividend focused and focused on ensuring that at some point our descendants will be able to qualify for mortgages based on the number of shares that we've accumulated by investing $100 or $50 weekly or bi-weekly and just forgetting about it, right? So your future portfolios can and should be less focused on dividends. My experience was that I had a pretty good circle of 20 or first portfolio. Everything paid a high dividend. But what I found was that I was missing out on growth stocks like Alibaba and the like, right? So my second portfolio, I used the same metrics to select those stocks or to analyze those stocks, but it was not as heavily focused on dividends. So for that portfolio, I was more focused on, do they have a lot of cash on hand? Is the revenue growing? And I call that my growth portfolio. But yes, for the purpose of the first portfolio, we're going to be focused on dividends and growing wealth for our descendants. But then you can turn right around immediately and use this same information to create any kind of portfolio that you should choose, right? So again, my experience was that the easiest and most surefire way to grow your stock holdings is by just doing it dollar cost averaging, and doing it automatically and having your dividends reinvested. That's drip. We don't really have to go into that, what drip investing is, because most brokerages and apps offer that now. So just gonna go over the action steps real quick. What we encourage you to do, because these are the best of the best companies in the United States, is that you start your research process using the Fortune 500 list. So you can either use the worksheet that Ronnie used earlier, or you can just go out and Google the Fortune 500 companies. And then I would suggest that the next thing you do is you search which of those Fortune 500 companies pay a dividend, and that you do your research, the same research that Ronnie just showed you how to do on those companies for the first portfolio. So based on the dividend yield and the amount of cash on hand and so forth, you're going to come up with 20 to 25 of the best companies, and then you will create a pie using your M1 or whatever brokerage. Another reason why I like M1 is because if I wanted to do the same thing in Fidelity, I had $100 that I wanted to spend across 20 stocks, then I would have to go in and individually place orders for each of those 20 stocks. Whereas with M1, you can put those stocks in a portfolio or a pie and say, I got $100, figure it out. And what they'll do is they'll evenly distribute your $100 across those 20 companies every time you deposit it. Makes it very simple. So we talked about, your individual budget and your pay period, etc. It's going to determine how much you invest and how often you invest. And then you want to make sure that when those dividend payments come in, because each one of these companies is going to pay you a dividend, that they're reinvested, and one takes care of that for you automatically as well. The other thing that we suggest you do, and that is an option with M1 that isn't with, say, like a Robinhood, is that you set up an account beneficiary. So that in the event something happens to you, your children don't have to fight to have control over your stock assets held in M1. So we want to make sure that you guys do that. And then the most important thing on this list of action steps is somehow, I would share this course with them, but somehow you have to make sure that whoever you are bequeathing your portfolios to understands the things that you understand, and what to do with them to continue to build generational wealth, and so that all your efforts are not squandered in one generation. So that's probably the most important thing, is that once you have this portfolio set up and your beneficiary in place and you're committed to investing weekly or bi-weekly, that you make sure whoever you're leaving this stuff to understands. And that's another thing that we try to do here today, is just make it simple, so that your preteens and teens can understand what it is that's going on and how to find the different metrics. And you guys will get this slideshow in an email after the presentation is over. But if you wanted to use that worksheet that Ronnie used, the link for that is the first one on the first slide. If you want to use one that kind of does, it's the same sheet, but it fills in a lot of the information for you. It lets you know what the dividends are, and it gives you the operating income and the interest expense. That would be the cheat sheet. And if you don't have a lot of time, you want to get into some emerging industries, Ronnie and I do billionaire babies reports, and they are just highly focused on more speculative investments. So once you do your dividend focused generational wealth portfolio, you may want to look at that if you have been hesitant or not able to get into some stuff like the EV market, or we've done a report on the cannabis market, and what it gives you is all of the details that you need, all of the details that we've gone over today, and then some, on all of the heavy hitters in these particular industries. So once you finish your portfolio, if you'd like to move on to options training, there's some links here where you can access consultations, some other trainings that we're doing. Tech Thursdays is one that's been really popular. And then lastly, you have our 2 YouTube pages here. So now I'm going to just go to the chat and see if anybody has any questions about how to use what it is that you've learned today.
Okay, seeing we have no questions or anything, okay, well, one just came up. Okay, I have a few brokerage accounts with minimal investments in them. How do I go about consolidating? There are ways where you could go through your brokerage and closing out that brokerage and having it transferred to the particular brokerage that you want to do. However, said that they